Welcome back to the Daily Crypto Roundup. Today is Sunday, December 28th, and this is your complete breakdown of everything happening across the crypto market right now. Even as we move through the holiday period, markets are still active, money is still moving, and narratives are still shifting. Thin liquidity can exaggerate moves, but it can also hide deeper trends that only become obvious when you step back and look at the full picture. That's exactly what we're doing today. Before we get into the detail, here's a quick overview of what we're covering in this episode. We're looking at why certain altcoins are quietly outperforming Bitcoin and Ethereum in thin trading, even as precious metals continue to rally. We'll cover major regulatory developments out of Hong Kong that signal where global crypto oversight is heading next. We'll break down escalating legal tensions involving Binance and WazirX. We'll examine why the total crypto market cap is pulling back despite selective strength. We'll look at Bitcoin's struggle just below the $90,000 level, ongoing exchange-traded fund outflows, and what that means for sentiment. We'll also touch on new debates around Ethereum exposure via public equities, the fallout from a Coinbase-related data breach case, and what all of this says about where crypto stands as we head toward the end of the year. Let's start with price action and market structure, because that's where most people's attention is right now. In today's trading, we're seeing something slightly unusual. Bitcoin and Ethereum remain relatively flat, struggling to generate meaningful upside momentum. But at the same time, a number of altcoins, including XRP, Solana, and Dogecoin, are quietly outperforming on the day. This isn't a full-blown rotation. It's not an altcoin season. But it is notable, especially given how weak breadth has been over recent weeks. This kind of selective outperformance often happens in thin markets. With fewer participants, smaller inflows can have a bigger impact on price. But it also tells us something about positioning. Many traders have already reduced Bitcoin exposure after the failure to break convincingly above $90,000. That creates space for short-term relative strength elsewhere, even if the broader trend remains cautious. At the same time, we're seeing precious metals continue to rally. Gold and silver are pushing higher, reinforcing a broader macro theme that's been developing for weeks now. Capital is leaning toward perceived safety in hedging assets. That puts crypto in an awkward position. It wants to be seen as a hedge, but it still trades like a risk asset in many portfolios. When metals rally and crypto doesn't, it creates tension in the narrative. That tension is reflected in the overall market cap. Despite pockets of strength, the total crypto market value has pulled back over the last 24 hours. This isn't panic selling. It's not capitulation. It's more like quiet withdrawal. Traders are stepping back, not rushing for the exits. Holiday conditions amplify this effect. With lower volume, there's less conviction behind moves. That makes it harder for trends to develop and easier for markets to drift lower without any dramatic headlines driving them. Now let's move to regulation, because one of today's most important stories comes out of Hong Kong. Hong Kong has advanced new crypto licensing rules for virtual asset dealers and custodians, continuing its push to position itself as a regulated digital asset hub. This isn't just a local story, it's part of a broader global pattern. Jurisdictions that want crypto business are increasingly offering clarity rather than hostility. They're saying, here are the rules. If you meet them, you can operate. This matters because regulation doesn't kill markets. Uncertainty does. For years, crypto firms have struggled with unclear or shifting rules, especially in major financial centers. Hong Kong's approach sends a signal that crypto is being treated as a legitimate industry, not a temporary experiment. Alongside this regulatory news, we saw speculative excitement around an artificial intelligence-related token tied to a pre-sale narrative. While these kinds of moves grab headlines, they also serve as a reminder that speculative behavior hasn't disappeared. It's just become more selective. Traders are willing to chase upside, but only in specific high-volatility corners of the market. We are going to take a quick break here for a word from our sponsors. Stay with us. Now let's talk about legal tension, because another major story today involves an escalating dispute between WazirX and Binance. The chief executive of WazirX has confirmed that an ownership dispute with Binance has entered the litigation phase. This is significant for several reasons. First, it highlights how messy the early days of crypto exchange partnerships were. Deals were often struck quickly, across borders, and without the kind of legal clarity that traditional finance demands. Second, it underscores how the industry is maturing. As crypto becomes more regulated and more valuable, disputes are no longer handled quietly or informally. They go to court. That's uncomfortable in the short term, but it's part of becoming a real industry. For users, these disputes are a reminder that exchanges are businesses, not neutral utilities. They have interests, incentives, and sometimes conflicts. Understanding that is part of becoming a more informed participant in the space. Now let's zoom back out to the broader market picture, because today's price softness isn't happening in a vacuum. Several reports today point to weakening market breadth. In simple terms, fewer assets are participating in any upside. When that happens, rallies become fragile. Even if headline prices look stable, the foundation underneath is thin. This connects directly to Bitcoin's current position. Bitcoin has been trading toward $89,000, but continues to struggle below the psychologically important $90,000 level. Every attempt to push higher has met selling pressure. At the same time, exchange-traded fund flows have turned negative on a short-term basis. This doesn't mean institutional interest has vanished. It means positioning is being adjusted. Funds that saw strong inflows earlier in the year are rebalancing, locking in gains, or waiting for clearer signals before adding exposure. In a thin market, those decisions have an outsized impact. The result is a kind of stalemate. Bitcoin isn't collapsing, but it isn't inspiring confidence either. That's a difficult environment for traders and investors alike, because it tests patience more than conviction. Now let's talk about a slightly different angle that came up today, involving public equities and crypto exposure. A company called Bitmine Immersion Technologies has been in the headlines due to debate around its Ethereum staking exposure and how that should be valued by equity investors. This is part of a growing trend where crypto exposure is being expressed indirectly through stocks rather than tokens. For some investors, buying equity in a company with crypto exposure feels safer or more familiar than holding the asset directly. But it also introduces complexity. You're no longer just betting on Ethereum or staking yields. You're betting on management decisions, operating costs, and equity market sentiment. These kinds of stories highlight how crypto is blending into traditional finance in unexpected ways. It's no longer just about tokens and wallets. It's about balance sheets, valuations, and disclosures. Now let's address one of the more serious stories of the day, a development involving Coinbase. Coinbase has confirmed that an arrest has been made in India in connection with a data breach related to the exchange. The company's chief executive publicly thanked local authorities for their cooperation. This story matters because it touches on trust, which is foundational in finance. While this case does not involve a direct loss of user funds, data breaches erode confidence. They remind users that even regulated, publicly listed exchanges are not immune to operational risks. As crypto adoption grows, so does the importance of robust security practices, both technical and organizational. This also ties into a broader theme we've seen all year: accountability. When things go wrong in crypto now, there are investigations, arrests, and consequences. That wasn't always the case. It's uncomfortable, but it's also a sign of maturation. Now let's bring these threads together, because on the surface, today's headlines may seem disconnected. Altcoins outperforming here, regulation there, legal disputes somewhere else. But there is a unifying theme. Crypto is in a transition phase. It's no longer a fringe experiment, but it's not yet a fully settled asset class either. It's navigating regulation, institutionalization, and global integration all at once. That creates friction, it creates confusion, and it creates periods like this, where price action feels underwhelming even as structural progress continues. As we approach the end of the year, this tension becomes more pronounced. Many participants expected fireworks. Instead, they're getting consolidation, legal headlines, and regulatory updates. That can feel disappointing if you're focused on short-term price, but it's arguably necessary for long-term stability. Before we wrap up, let's reflect on what this means going forward. Short-term, markets are likely to remain choppy. Thin liquidity, year-end positioning, and unresolved macro questions all point toward continued volatility without clear direction. Medium-term, The stories that matter most are not daily price fluctuations. They're regulatory clarity, institutional behavior, and infrastructure resilience. Those are slower, quieter forces, but they shape the next phase of growth. Long-term, today's headlines will probably be remembered less for the exact price levels and more for what they represented. A market learning how to behave like an industry rather than a speculation engine. And that brings us to the community part of the show. A genuine thank you to everyone who comments daily. The engagement, the discussion, and the thoughtful disagreement are what make this show worth doing. It's humbling to see the same names return and new voices join in. We hope you have had a fantastic Christmas and are rested and ready for what's coming next. This is a conversation, not a broadcast. We'll keep covering it every day, through the holidays and beyond, because this is when context matters most. Drop your thoughts in the comments, like and follow, and as always, we will see you at the top.